This is my investment portfolio today. It's worth just under 900,000 and it has very little invested in equities. So am I just a glass half empty perma-bear? And what would actually make me buy stocks again? To explain this, let me take you back to 2020. Because there was a point when I went from being defensive to becoming nearly fully invested over a couple of weeks. I didn't predict COVID, I didn't know where the bottom was, but something changed that altered the balance between risk and reward. And if those same conditions came together again today, I'd be ready to do exactly the same thing. Let's go back to the start of 2020. I was positioned defensively, lots of cash and a small amount of hedge funds and wealth preservation funds. That wasn't because I thought a global pandemic was coming, it was because I thought the balance between risk and reward wasn't particularly attractive. Valuations were high by historical standards, higher than much of history, and people were complacent. Stock markets had been on an incredible run, and people were thinking stocks could only go up. Most people were bullish on stocks, and that's often a sign you should be careful. Then COVID hit. What followed was one of the fastest market crashes in history. From its peak on the 19th of February to its low on the 23rd of March, the S&P 500 fell almost 34% in just 23 trading days. MSCI World fell 25%. On the 16th of March, the Dow Jones fell 13% in one day, the third worst trading day in all history. It took only 17 trading days to enter a bear market, a decline of more than 20% from its peak, the fastest on record at the time. And every day seemed to bring another wave of bad news, and investors were selling into a rapidly deteriorating situation. Markets recovered quickly once people realized the world was not over, but by the end of the first half of 2020, a global equity tracker was still down around 1%. In a sense, this is what I had been waiting for. The market wasn't just lower, it had become meaningfully cheaper. Before COVID, investors were paying around 19 times expected earnings for the S&P 500. After the crash, that had fallen to around 14. Nothing was certain, earnings forecasts could still prove too optimistic, but for the first time in a long while, I felt the probabilities had shifted in an investor's favour. But valuations weren't the only thing that changed. Investor psychology had completely flipped. Just a few weeks earlier, investors were optimistic. Now they were fearful. The CNN Fear and Greed Index had collapsed to its lowest ever reading of 2. People were selling equities because they were scared. People were no longer saying, buy the dip. They were saying, markets are going lower. And when people are scared, that's when the best opportunities arise. So as the market started falling, I started moving my cash and defensives back into equities. I wasn't trying to predict the bottom. I was simply responding to a market that I believed was becoming significantly more attractive. On the 9th of March, I invested around 6% of my portfolio. The 10th of March, another 7%. The 11th of March, another 6%. Then came the 12th of March. Markets suffered one of their worst days since 1987. Instead of stopping, I invested another 27%. 13th of March, another 13%. 16th of March, the Dow Jones fell almost 13% in a single day, the third worst trading day in its history. My portfolio was now down 6%, and I invested another 5%. The next day, another 5%, then another 6%, then 13%. And finally, on the 20th of March, I invested another 13%. At this point, I was over 90% invested in equities. And over the next few days, my portfolio continued to fall, and at its worst was down 8.5%. But my process hadn't changed. Valuations were lower, fear was higher, so I stayed with it. I believe that now was a good time to be invested, even though many other investors thought it wasn't. And the recovery came far quicker than almost anyone expected. As markets rebounded, so did my portfolio. I hadn't bought at the exact bottom. In fact, at its worst, my portfolio was still down over 8%. But by the end of the first half of 2020, my portfolio had recovered all of its losses and was firmly making money. And by the end of 2020, my portfolio had returned 30%. Over the same period, a global equity tracker returned 16%. But this isn't really a story about beating the market. It's about my process of focusing on valuations, paying attention to greed and fear, and buying when the probability shifted in my favour. I didn't know where the bottom would be. I didn't know how quickly markets would recover, but the time to buy was when others were selling. So that brings us back to today. My portfolio now looks very different. I'm very defensively positioned in cash, short duration inflation-linked bonds, gold, and defensive funds. To many people, that probably looks far too cautious. I'm not sure when or if a crash will happen, but once again, I don't think I'm being paid enough to take equity risk. One reason is valuations. The CAPE ratio is even higher than it was in 2020. We are near record levels, and historically, these levels have been associated with lower long-term returns. That doesn't mean markets can't keep rising. It simply means the odds don't look attractive. If valuations became significantly cheaper again, I'd start buying again. The second thing I look at is investor psychology. Today, many investors seem convinced that equities only go one way. Buy the dip, use leverage, stay fully invested, don't worry about valuations. Maybe they're right. But when investing starts to feel easy, that's often when I become more cautious. Nobody rings a bell at the top. Nobody rings a bell at the bottom. All we can do is weigh the evidence in front of us. Right now, I don't think I'm being paid enough to take much equity risk. Fortunately, my cash is paying me to be patient. If the odds improve, I'll happily buy more equities again. But until then, I'm comfortable waiting. Thanks for watching, and I'll see you in the next one.